One of the main challenges facing Canada's big banks is the risk of bad loans. Bad loans are loans that borrowers cannot repay or default on. When this happens, banks lose money and have to write off the loans as losses. To prepare for this possibility, banks set aside money as provisions for credit losses, PCLs. PCLs reduce the bank's profits and earnings, but also protect them from future shocks. In 2023, Canada's Big Six banks increased their PCLs significantly compared to the previous year. According to their financial reports, they set aside a total of over $2.4 billion as PCLs in the first quarter. Of this was the biggest buffer for credit losses since the first year of the pandemic, when the banks also built up provisions before government supports and consumer savings helped prevent a wave of loan delinquencies. The increase in PCLs was driven by several factors. First, the banks anticipated a severe economic downturn caused by a new wave of the pandemic and a resistant COVID-19 variant. Second, they expected higher interest rates and inflation to put pressure on household and business finances. Third, they observed a rise in delinquencies and write-offs in some consumer lending portfolios, such as credit cards, lines of credit, and auto loans. The banks said they did not expect a dramatic spike in defaults, especially on mortgages, which are backed by collateral and have low default rates. They also said they had strong capital buffers and high loan loss reserves going into the scenario, which would help them absorb additional loan losses. However, they acknowledged that credit loss trends would normalize from the low levels experienced during the pandemic, and that they would continue to monitor the situation closely.